Hello, this is Wilfred Hahn, Chairman and Co-Chief Investment Officer of Hahn Investment. I'd like to bring you the update for June. It certainly was a momentous month. Lots of issues preoccupying minds of investors and scaring investors around the world. We want to cover some of those things, but let's first go to a quick update as to how markets did last month. Overall, bond markets again had a down month pretty much everywhere in the world, although some of the emerging markets fixed income instruments did pretty well. But nonetheless, this is the second quarter, probably the second month in the last quarter that bonds haven't done so well. Equities overall, also a down month for June, and we'll explain why in just a moment. Year to date, however, equity markets are up, not much in Canada. In the U.S. and elsewhere, they're up quite a bit more, 9%, 10% for emerging markets, 13, almost 14% for EFI markets. But most of that return comes from currencies. In other words, the Canadian dollar has been weak versus the U.S. dollar pretty much for most part of the year, even though there was a rally in the midst of that. But so overall, equity markets, if it weren't for currencies, would be going pretty flat, about 1 or 2% so far this year. And thankfully for Canadians, at least with global content, that's been a lot better. Elsewhere, not much excitement. The euro currency was a little stronger, which is somewhat interesting given that there is so much tumult around Greece. One would have expected that the euro would have been a little bit weaker, but it just goes to show that a lot of negative sentiment is already in the market prices. And elsewhere, currencies, commodities, so on and so forth, oil, and so not much of a story this last month. However, as mentioned, there were a couple of big events. I want to talk about that just briefly. Things happening in China, particularly the Chinese equity market, and this Greece referendum, which we'll hear about shortly, and what does that all mean for Europe. Well, let's first turn to portfolio performances overall. As you can probably guess, given the overall markets haven't done so well, for the short-term period of just a month, again, a down month. That's sort of the second month in a quarter. Year to date, the portfolios are still doing very fine. We're outperforming. But we're in a period of time here where the world and its financial markets are sort of taken up with some fears. And that's not a bad thing as long as it's fully discounted, the fears and prices to this point. Usually, and I'll turn to these explanations next quickly, both these issues that I talked about. There is a bit of furor and worry about what's going to happen in Greece and also what's happening in the Chinese equity market. But the thing to realize, and we have to be careful about trying to time these kinds of things, it's when these things are well recognized and everybody is fearful, and that fearfulness is already priced into the prices. That's the wrong time to run. And in any case, one has to look longer term to get a sense of what this all means once these crises resolve themselves. There's been lots of policy crises over the last 4, 5, 6 years. I can think of many of them. And everybody gets sort of fixated on these things. It's not that they're not important, but everybody gets fixated on them. That seems to be the only thing that preoccupies the minds of investors. And certainly that's the case if you look into business papers these days. Virtually, half the articles are about Greece, and the other half are about some things that are happening in emerging markets, Ukraine, and particularly China. So, what does all this mean? I'll just mention a couple of quick things here about Europe. We don't know what the outcome is going to be of the referendum, but in the end here, we're still thinking very much that even though the European Union will have and continue to have problems longer term, that's the challenges of having this one currency across all those countries. It's not going to be resolved by just resolving Greece. But when they have a resolution for Greece in the next couple of days, no matter which way it goes, European equity markets are likely to soar. They may be up 10% in a couple of weeks. Just that advent of that worry being out of people's minds is going to drive up those equity markets, I would guess. We don't know for sure, but typically that's how it happens. Also, we have a bit of a correction in China, the equity markets there, and again, that's drawing everybody's attention, so I'll comment to it. We're quite positive on China intermediate term. We won't see a longer term. China has problems that it's not going to be able to resolve longer term, so we need to stay somewhat cautious on those points. But intermediate term, there's a lot of interesting things going on in China. We'd suggest that you look at our next global wealth perspectives, in which we're going to publish an article on China. Very interesting what's going on there and what China is planning. And in that context, if you view what's happening in China, slowing economy, some reform ongoing, so on and so forth, those are the kind of environments which everywhere else in the world contributed to financial markets inflating somewhat because of the policy decisions that come in. And that's kind of what's happening in China here right now. There have been lots of speculators that have jumped into the Chinese local stock markets, so that would be the mainland stock markets, and a lot of people have been borrowing money, and that's not sustainable. So from a policy perspective, the government and the financial organizations sponsored by the government need to sort of tame those emotions that are impacting those markets. And that's kind of what we've seen here now. You'll read in the paper that the Chinese equity markets are down 30%. Well, they're up 160%, or at least they were up 160% prior to that point in time, and they haven't even fallen back to, I think it's late March levels of this year. So still some pretty big gains in the Chinese equity markets to this point. And we think it's going to continue to be rocky, pretty much in a lot of markets. So we've said a number of times in our presentations so far this year that we expect we're going to be in an environment of volatility here for a long time. So the best approach to take is what we're doing, we believe, and that's to stay very diversified, broadly exposed to all kinds of asset types that'll offset each other, and that should work well longer term. But most importantly, one shouldn't be shaken off some of the longer term trends just because there are some short term exigencies. What does happen, and this is what we expect longer term, I'll just say a couple perspectives about that, is that we continue to expect that central banks, policymakers, are going to continue to intervene. However, they only do intervene when there are crises. And so environments like this prompt those kinds of actions, which equity markets and financial markets will tend to like. These aren't long-term solutions by any means, and we don't present them as such, but they are factors in the short-term sort of movements of financial markets, and we expect that to happen. Also here in the U.S., in that U.S. economic growth also has been disappointing. That's another worry. But it's just going to induce some more policy decisions on the parts of central bankers and so forth, which will possibly have some ameliorating effects here over the short term. So that's our update for this month. We'd ask you to have a look at the presentation we did the previous month in this update, some perspectives on how to evaluate longer-term trends versus shorter-term trends and how does that impact portfolios. It's very important to keep an intermediate to long-term perspective. And finally, again, would mention that this next Global Wealth Perspective, which will be published in the next couple of weeks, has some very interesting articles in it. And as always, please visit our website for additional articles and information. Thank you for joining us. Goodbye.